Hey, if you're looking to create a set of financial projections for a bakery startup, then you've come to the right place. We have created a financial projection template built specifically for bakery startups. And this is going to be really useful if you're trying to get a loan from a bank and the lenders ask you for your financial projections, or maybe you're trying to raise money from a potential investor. This template is going to really help you produce the deliverable, the set of financial projections that you're going to need in order to raise capital. And so I'm going to walk you through how to use this template today. I put a link to this template down in the description of the video below. And while you go down and grab that link, it'd be great if you like this video and subscribe to our channel, as we try to help entrepreneurs create financial projections to help them start and launch their business. So before I dive in too far here, my name is Adam Hoeksema. I'm the co-founder of Projection Hub. And over the last decade, we've helped over 50,000 entrepreneurs create financial projections for all sorts of different types of businesses. Today, we're specifically focused on this bakery template. So with that, let's go ahead and dive in. Okay, so we're going to actually start with the end in mind here. So this is the At a Glance tab, and this is what you'll get after you have entered in all of your assumptions for your specific bakery, and you'll be able to see a profit and loss at a glance, some nice summary data, some different charts and graphs, tables that are going to be helpful for a business plan or a pitch deck. You're also going to get a 5-year income statement summary, 5-year cash flow summary, a 5-year balance sheet summary, and then the income statement, cash flow, and balance sheet report, all broken down by month for each of the 5 years. So you have all of that detail that you might need. In order to produce these reports, though, we have a little bit of work to do. We need to talk about these input tabs. So I'm going to jump to the input assumptions tab to start with here. And the first thing you need to know is that every cell that's highlighted in blue is an assumption cell that you can change without breaking something in the model. So you can put in our projection start month. Now, if you are going to put in some personal investment, probably if you're trying to get a loan, the lender is going to require that you have some skin in the game, that you put some investment into the business yourself. So we're assuming here a $25,000 personal investment. We're assuming leasehold improvements, building improvements of $60,000, kitchen equipment of $15,000, furniture of $10,000, and glassware of $2,500 to help you get this off the ground. And then we can add an SBA loan or another loan here. We've added an SBA loan for $150,000, 9% interest rate, paid over 84 months. And then we're going to jump over to our input revenue tab. I'm going to zoom in here so we can see this a little better. All right, so we have an advertising budget that we'll set here on this other expense tab, but we'll have an advertising budget and then a cost to acquire a new visitor. So the assumption is that we're going to pay for ads and try to drive new traffic into the bakery. And we're assuming here that's going to cost us $10 to acquire a new visitor to come into the bakery. And we have a negative growth rate for this. So this annual change rate relates to the cost to acquire new visitors. So we're actually saying that over time it's going to get cheaper to acquire new visitors because we're going to get smarter about how we advertise and learn what works and what doesn't. So maybe that will actually get cheaper over time. So that will give us our new visitors from paid ads. And then we also have our new visitors from just organic or word of mouth. Okay, so these are our new visitors. Now we're saying, hey, we're going to have 1,000 people to start out with. But then what we should actually do here is let's decrease this by 10% over time, because over time you're going to run out of new visitors that haven't heard of your bakery. And so we would actually expect those new word of mouth visitors to decrease over time. So we'll put in a negative percentage there. That'll give us our total number of new visitors for the month. Now we're saying some percentage of those new visitors are going to become regulars that come back again and again. And so we've set percentages here, what percentage of new visitors will become regulars, and then what percentage of regulars will leave each month. So you're going to lose some of your customers each month. Just people move, people find different, maybe different bakery to go to or different restaurant to go to, or change of diet habits, something that might cause them to leave, right? So we'll have some percentage of regulars who leave. Then from there, we can say, okay, of those regulars, how many visits per regular per month can we expect? And so we're saying 1.5 visits per month per regular customer. And that will help us determine our total customer visits during the month. And from there, now we're going to get into, okay, what are those customers buying when they come in? So we'll say we serve coffee, tea, espresso drinks, bagels, scones, muffins, and donuts. So are kind of our main offerings. And then we have some merchandise, t-shirts, mugs, and travel mugs. And what you can do is you put in the price. This is the price that the customer is going to pay to you. And then what I've done is, you can see up here, this is a calculation. So this is the cost, your cost of goods sold for the coffee. So I just made this the price of the coffee times 0.3. In other words, your cost is 30%. So you have 30% food cost. And now you'll want to do your own research on this. And depending on your menu items, you could have some menu items that your food cost is 10% and some where it might be 50%. So you want to do that research as best you can. Then from there, we're going to say, okay, in this column, the average number of purchases per person per visit. So we're saying that on average, the average visit is going to have 0.2 coffee. So in other words, 20% of customers, 0.2 or 20%, are going to buy a coffee, and 10% are going to buy a tea, 20% are going to buy an espresso drink, 30%, 0.3 will buy a bagel, and so on. So you can fill that out based on what you expect to be your most popular items. All right, and so this table will just kind of show you then, based on what you entered in, it's going to say, hey, each customer is going to order 1.9 drinks and or food items from you. So that might sound right. Maybe on average people get one muffin and one coffee. So maybe that's a pretty reasonable assumption here. And the average spend per person then is $4.40, and the average cost of the business is $1.32. All right, and then this is just going to allow you to say, hey, I want to increase my prices each year, so we can increase those prices by 5%, and we can expect our cost of goods sold to increase too, so we have that set to 3%. And that will allow you to project your revenue for the business, so your bakery and coffee revenue and your merchandise revenue. We're going to move over to our direct labor tab. So this is, you're going to enter in how many hours you expect to be open each week. And so these are the hours that you're open to the public, but then also expect to have some hours where you have staff, but you're not open to the public yet. So we're saying, hey, there's going to be 14 hours of kind of each week of opening and closing work where we're paying an employee to be there for opening and closing, but we're not open to the public yet. So that's what you want to enter there. You can enter in your employee hourly rate, and then the transactions per hour per employee. So this would be if you just had one employee in the entire bakery and they were taking orders and preparing the orders, how many orders could they process per hour? That's what you want to get at here. So, and this really depends on the nature of the type of product that you're serving. How much prep work does it create? So if it's espresso drinks that are kind of specialty drinks that actually take a lot of prep work or a lot of work, a lot of time to prepare, maybe 8 transactions per hour per employee is really all that you might be able to handle. On the other hand, if you're just doing drip coffee and you just need to pour a cup of coffee and you're on your way, you could probably process a lot more transactions per hour per employee. So you want to make sure you do your own research. And the reason this is important is because this is helping us calculate how many employees we're going to need to make sure we have on staff per hour. And then this is the hours per week per employee. We're saying 30 hours. And we're saying the minimum employees per hour. So we're saying minimum we need to at least have 2 employees at the bakery, in all of our open hours. So then this is going to then project out, and what it's actually going to do here is tell us how many staff we're going to need, and then ultimately what that direct labor expense is going to be. All right, now we can move on to our other expenses tab here, where we can enter in different operating expenses. So we've got costs for accounting and bookkeeping, or point of sale software, transaction fees. So this is something I want to point out, is that for any of these operating expenses, you can select whether the expense is a fixed dollar amount, meaning it's the same dollar amount month to month, or whether it's a percentage of revenue. And so we can say, hey, this transaction fees or credit card processing fees are going to be a percentage of revenue. Typically that's between 2 and 3%, or maybe a little over 3%, but not all of your customers are going to pay with credit cards. So those that pay with cash are not going to have that transaction fee. So we're saying, hey, on average, we think our transaction fees or credit card processing fees are going to be 0.02 or 2%. That's how you'd enter in 2% of total revenue. We have insurance costs, rent, supplies, utilities, internet, repairs and maintenance, and so on. And you can enter in additional operating expenses that you expect to have. And you'll want to do your own research on these numbers. These are just kind of general ideas, but this could vary dramatically depending on your particular model, the size of your bakery, where you're located geographically, and so on. So you want to do your own research, not just accept these numbers as the right numbers, okay? All right, and then we can enter in salaried positions. So we've already entered in that direct labor, the hourly staff, but if you have salaried positions like a manager, supervisor, shift supervisor, that sort of thing, you can enter in those salaried positions here. You'll want to notice you can enter in their salary and benefits and the start month here. So what we're saying here is that we're going to hire a manager right off the bat in month 1. Then we're going to hire a supervisor in month 25. So the beginning of year 3, we think we've grown enough, we're going to hire a supervisor. So that's what that is, how that is being filled out there. And then month ending is 60 because this is a 60-month model. So this is really saying these employees are on staff through the entire 5-year projection. Then you can say how many of this particular employee do you have. So if you have, maybe you're going to hire 3 shift supervisors all at once. You could change this to 3 and it would multiply your salary expenses there by 3. And you can add an annual raise. And once you've done that, we are done. We're back to our at a glance tab. And what we'll notice here is that we are not making money in this bakery based on the assumptions that we've put in. So, kind of back to the drawing board, and we want to think about why. What is it that might be causing us not to make money? So I think I want to show you a couple of the key levers that you might want to take a look at or address, and that could make a big difference for you. So if we look at the number of visits per regular per month, so this could be a key driver. So if you can get those regulars to visit even just a little bit more often, that's going to make a big difference. So let's say we can get those regulars to come 2 times a month, and come back to our at a glance. And now we can see just that small change brings us to a level of profitability. At least by year 4, we're profitable. And so that's just an example here of how you want to review your projections after you've entered in your assumptions and make sure they make sense and that they look profitable, and work to make adjustments. You may have to adjust your expenses or try to figure out ways you could generate additional revenue. So I hope that's been helpful. If you have any questions, please leave a comment in the video comment section of this YouTube video, or reach out to us directly at support@projectionhub.com, and we will do our best to help you. Thanks.